Can you build a 100% Canadian investment portfolio and still get strong returns? What about diversification? Fasten your seatbelts, folks. This is going to be a good one. Creating a pure Canadian portfolio is easy enough to do. And, well, there are potential benefits for sure. You are helping the Canadian economy and at the same time also creating a more favorable tax situation in both, well, your registered and your non-registered accounts. Also, staying within Canada removes any form of currency conversion factors, which, of course, makes the math a little bit on the easier side. On the downside, there could potentially be some diversification concerns. Canada has a strong but concentrated stock market. The TSX is heavily weighted towards financials, energy, and materials. In addition, our Canadian economy is much smaller than our neighbors to the south, and it's also heavily dependent on exports. With a US trade war brewing, this becomes a pretty big concern for our investments. I mentioned that the TSX is heavily weighted towards some sectors. That does imply that we have a few sectors that have limited exposure as well. Technology, for example, is simply not as well represented on the TSX as it is south of the border. A sub to the channel is the best way to represent when it comes to future content. In building a 100% Canadian portfolio, one of the first questions we need to ask is if we are buying stocks or ETFs, or perhaps even a combination of the two. Individual stocks will give you more control over your investments, and they do come with a potential for higher gains. However, they do require more of an active management approach, and they do come with a research requirement for sure. Finally, they can result in diversification concerns if you have them too concentrated in only a few sectors. ETFs or exchange traded funds, on the other hand, they often bring, well, instant diversification to the table. They will often contain multiple companies and, in some cases, sectors as well. Their basket of stocks approach to investing lowers risk big time thanks to broad exposure. They also tend to have lower fees than mutual funds, which is a plus for sure. The potential trade war with Trump and his tariffs are set to cause a lot of pain to the Canadian economy. In setting up a 100% Canadian portfolio, you must take this into consideration big time, as it will impact many companies in major ways, and the collateral damage will affect pretty much everyone. This is where your overall investment strategy comes in. If you are growing your investments on a long-term scale, your strategy may not be about avoiding the economic potholes, but rather, well, doubling down on them. Strong, fundamentally sound companies are going to be fine on the other side of these tariffs, and you may have some very good buy the dip opportunities for sure. If you have an income portfolio, you may want to shore up your income ETFs into safer sectors. You may also want to consider going with non-leveraged versions when you are in riskier sectors with a lot of downward potential. Of course, at the bottom, switching back to leverage may net you some nice returns as you hang out at the bottom for a while, and of course, ride it back up when it rises. If we do have a trade war, the sectors you may want to watch include energy, utilities, materials, and financials. I will also add that telecommunications could potentially be a wild card, but I am hesitant to recommend them at this point. I asked earlier if you should go with stocks or ETFs in your pure Canadian portfolio. My answer to that is that you can do either. However, if you are doing stocks, then just take extra care to mind that diversification. We are going to take a quick look at 3 stocks and, well, 3 ETFs that I believe are potentially great options in that 100% Canadian total return portfolio. We will start with the stocks and we'll kick things off with a bank. And right now, one of our best is Royal Bank with a ticker of RY. At the time of recording, their price was coming in at $169.22 and a very stable beta of 0.83. Their earnings per share coming in at 11.25, and they've got a PE ratio of 15.04. Their return on equity, 13.40%. Looking at their dividend, they do have a yield of 3.498%. That's a quarterly dividend of $1.48 per share. As for returns on the 3 year, their return on investment came in at 22.61%. Add in the dividends, total return 34.34%. On their 1 year, that return on investment 28.48%. Add in the dividends, total return 32.81%. Their 3 year annualized, that's coming in at 10.34%. It is true that the banks are in the middle of a mortgage renewal wave, but they have set aside a lot of money for loan loss provisioning, and so far, they have used less than anticipated. Up next, we have Torlamine with a ticker of TOU. They are a massive Canadian energy company that have been doing so well over the last many years that they're often giving out special distributions in addition to their regular dividend offerings. At the time of recording, their price is coming in at $69.73. They have a beta of 1.24. Their earnings per share, 4.43. And they have a PE ratio of 15.74. That return on equity, 11.46%. In terms of their dividend, their yield is at 1.893%, quarterly dividend of 35 cents per share. And also remember, they are giving out a lot of special distributions. So far, that has not stopped. So you may get some bonuses in the case of Torlamine. Looking at their returns on their 3 year, that return on investment, 33.43%. Factor in the dividends and those special distributions, and we get a total return of 65.04%. Holy banana bread. That's pretty good. On their 1 year, their return on investment, 17.63%. Add in the dividends, total return 22.39%. Their 3 year annualized, 18.18%. Keep in mind that 3 year annualized does not include their dividends. So that the dividends and of course that special distribution has been the highlight of this stock for sure. The US needs our oil exports, which is why we are only seeing a 10% tariff talked about regarding Canadian energy. That will cut into the bottom line. But Torlamine has a pretty darn big moat which can easily weather it. Our final stock is Hydro One, which has a ticker of H. They are a great company for some exposure to the utility sector. At the time of recording, their price was coming in at $44.56. Their beta comes in at 0.34, earnings per share 1.92. That price to earnings ratio 23.21, and their return on equity 9.59%. Their dividend does have a yield of 2.82%, quarterly dividend 31.4 cents per share. Looking at their returns, on their 3 year return on investment, that comes in at 37.91%. Factor in the dividends, total return 48.93%. On their 1 year return on investment, 9.70%. Factor in the dividends, total return 12.79%. And that 3 year annualized, 14.20%. Utilities is a sector that continues to do well in economic downturns and also they really love low rate environments. They may be about to experience both of these conditions. And well, as a result, they certainly are going to keep the lights on for sure. Okay, let's take a look at some ETFs. So our first ETF is the iShares S&P TSX 60 Index ETF with a ticker of XIU. They provide exposure to Canada's top 60 biggest companies. Their top 3 holdings include Royal Bank, Shopify, and TD Bank. At the time of recording, their price was coming in at $38.39, and they have an NAV of $38.40. Their assets under management, $16.07 billion, and their management expense ratio, 0.18%. Looking at their dividend, their yield comes in at 2.904%. It is a quarterly dividend of 27.5 cents per share. As for their returns on the 3 year, their return on investment, 17.08%. Add in the dividends, total return, 26.44%. On that 1 year, return on investment, 18.67%. Factor in the dividends, a total return, 22.12%. Their 3 year annualized, that's coming in at 8.13%. This is a great ETF for a solid exposure to the Canadian market. and it will certainly help with your diversification efforts big time. Up next, we have the BMO Equal Weight Banks Index ETF with a ticker of ZEB. This ETF provides an equal weighting of Canada's big six banks. At the time of recording, their price was coming in at $41.85. Their NAV, $41.84. Those assets under management, 4.42 billion, and their management expense ratio, 0.28%. Looking at dividends, they have a yield of 4.014%, and it's a monthly dividend, the only monthly one on today's list, 14 cents per share. As for their returns, their 3-year return on investment, 6.14%, add in the dividends, total return of 18.06%. Looking at that 1-year return on investment, 20.61%, total return, 25.45%. On their 3-year annualized, that does come in at 5.69%. As I mentioned earlier, the mortgage renewal wave is a stressor for the sector, but thus far, they have all weathered it well, and the added tariffs will add more pressure, but I do feel the Canadian banking sector, well, they're up for the challenge for sure. Up next, we have the iShares S&P TSX Capped Energy ETF with a ticker of XEG. This ETF does provide great exposure to Canada's energy sector. Their top 3 holdings include Suncor, Canadian Natural Resources, and Cenovus. At the time of recording, their price was coming in at $17.31, and their NAV also $17.31. Those assets under management, 1.48 billion, and their management expense ratio, 0.60%. Looking at their dividend, they have a yield of 3.053%, quarterly dividend of 17.4 cents. On their 3-year, that return on investment, 25.34%, add in the dividends, total return, 38.16%. On their 1-year return on investment, 5.16%, adding in the dividends, total return, 8.76%. 3-year annualized, 11.38%. XEG has been a favorite of mine for some time. And, well, quite frankly, it is a very nice way to get in your energy sector diversification. Also, when oil soars, this ETF has been known to do very well indeed. Of course, these stocks and ETFs are just a sampling, and there are a lot of other great options out there for sure. I would actually be very curious to see your favorites. If you would be so kind as to drop them in the comments, I can't wait to take a look. If you are interested in any of the stocks or ETFs we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on utility income ETFs, and I'll see you in the next video.